Hello, ladies and gentlemen. If you want to become a high stakes trader, then you will need to develop a trading style that will firstly maximize your chances of generating big returns, whilst also minimizing your chances of experiencing big drawdowns. Unfortunately, it can take you a long time to find and fine tune the right trading style that is a good fit for your personality, your goals, and your circumstances. And to be honest, this concept of developing a trading style, it's an ever evolving and changing entity. However, in this video, I would like to discuss a few trading rules that will hopefully speed up your development as a high stakes trader. Now, when I say a few trading rules, I actually mean 17, but don't worry, each rule won't require too much of an explanation. So let's start off with rule number one, which is accept the nature of trading. In my previous video titled Habits of Successful Traders, I briefly mentioned that when it comes to financial trading, at any given time, there is a 70% chance that you will be in a drawdown. So this means that probably the most important skill that all high stakes traders have to develop is the ability to deal with the psychological stresses of being in a drawdown. So prepare yourself, but don't expect anyone else to help you in this regard. And here's why: um, if if you were to speak to people who don't trade, then they won't understand what you're talking about. And if you were to speak to people who do trade, then either A, they too will be going through a losing streak, and you know what they say, misery loves company. Or B, your fellow trader will be going through a winning streak, in which case you'll talk to them and you'll just end up being resentful. So learn to deal with drawdowns it because it is the fastest way to speed up your development as a trader. Rule number two: always trade with a stop loss. A sensible stop loss will prevent a controlled financial loss from turning into an uncontrollable financial disaster. So always trade with a stop loss. And if you choose not to trade with a stop loss and something goes wrong, then you only have yourself to blame. Rule number three: make two important promises to yourself. Before every trading session, promise yourself that you will never, number one, allocate additional funds to a position that is already losing money. And number two, or B, move your stop loss in a direction that is against your trade. So, for example, if you decide to buy a stock, then promise yourself that you will never lower your stop loss. And if you promise to sell it, and if you decide to sell a stock, promise yourself that you will never increase your stop loss. These two little promises will probably put you in the top 50% of all traders out there. Rule number four: diversify, but not too much. In my video titled Trading Mindset Hacks for New Traders, I stated that when it comes to financial trading and speculation, the weakest word is one. One trade, one position, one trade idea, one trading strategy, etc., etc. Now, I'll be the first to admit that if you really want to secure those hyper extraordinary gains, then your best course of action would probably be to place a few big bets throughout the year. Unfortunately, this strategy is not sustainable because all it takes is a brief losing streak to wipe out your entire account. So, in general, your trading account should contain between 3 to 10 trade ideas. These trade ideas should either be uncorrelated or negatively correlated in some way. However, please note that when market volatility is high, then all correlations tend to immediately converge to +1. Rule number 5: maintain a trading journal. Now, when you hear the word journal, you automatically think uh, a written journal. But if you want to become a truly high stakes trader, then why can't your trading journal be a multimedia affair? For instance, along with your handwritten journal entries, your trading journal could include the printout of your charts, um, videos of your trading sessions, particularly if you do a lot of day trading. Um, you could even include audio commentaries from yourself, and then you could replay these audio files, say when you're cleaning the house, washing the car, or just waiting in line at the post office. The most important thing about having a trading journal is that you've got to be diligent about it. Not a single day should pass whereby you don't create some sort of content for your trading journal. An alternative way to maintaining or creating a calendar based trading journal would be to maintain a trade based journal, whereby whenever you instigate a new position, you create sort of like a mini report, so to speak, whereby you record details such as why you instigated the position, your money management calculations, trade management issues that you've had to deal with, as well as justifications for why ultimately you ended up closing the position. But irrespective of the type of trading journal you choose to maintain, you must use your trading journal to have regular and in-depth reviews. Now, if you want, you could conduct, say, a mini review every month, but you should have a proper full-on trading review every quarter. The goal of each review, particularly the your full reviews, is to figure out 1 to 5 things that you could do that will improve your trading performance for the next quarter. You should look to capitalize your strengths and to turn your weaknesses into strengths. However, the latter is not always easy. For instance, if you're not the type of person who enjoys staring at a computer monitor 8 hours a day, then quite honestly, no amount of trader development will turn you into an outstanding day trader. Now, sometimes during a review, it might be difficult to pinpoint the precise problem concerning a lack of performance. Um, Under such a set of circumstances, during your review, you will need to develop a hypothesis, and then you need to make plans to capture data that, upon interpretation and analysis, will either support or negate your hypothesis. So here's a very simple example. Let's say you're struggling to generate good returns as a day trader. So during your quarterly review, you develop a hypothesis that your day trading performance, it depends on the day of the week that you day trade. So you could make arrangements to record the day of the week for whenever you actually do day trading. If you were to do this, then on your next quarterly review, you will then have a set of data that will allow you to make meaningful decisions regarding how and when you should day trade. Now, if you're truly struggling to find ways to improve your trading performance, then by default, you should automatically try and experiment with different ways of generating better and more trade ideas. This thing alone will have a significant impact upon your overall performance as a high stakes trader. Rule number 6: never trade with money that you need. Now, obviously, it goes without saying that if you need all your monthly income to pay your bills, to pay your rent, to run your car, etc., then unfortunately, for the time being, you can't afford to trade, and you need to take steps in order to deal with this issue. Now, this leads us on to our next rule, which is rule number 7. Only trade with money that you cannot afford to lose. We discussed this rule in my video titled, quote, "If you've got poor trading psychology, then watch this," end quote. But basically, you should view your trading account as a unique type of savings account whereby you are happy to take small amounts of short-term risk in exchange for large amounts of long-term reward. This simple rule will help you foster the right mindset, which in turn will help you become a high-stakes trader. Rule number 8: develop your own views about the future. Ultimately, financial trading is about making predictions about future market behavior. Now, from an intellectual perspective, trying to predict the future is probably one of the hardest things that a human being could ever do. Therefore, sometimes it might be tempting to outsource this aspect of your trading to other people. But this would be a mistake, and let me tell you why. Firstly, these people who you outsource this to, they don't care about your trading performance. Number 2, their assumptions, their priorities, and their time horizons will most definitely be different to yours. And number 3, these people, if their predictions are wrong, you have no recourse. For example, you can't exactly take them to court to get some type of compensation. Furthermore, the outsourcing of the forecasting aspect of your trading doesn't even begin to address the issue of minimizing your opportunity cost. This is important because when it comes to financial trading, your opportunity costs will always be your largest set of expenses. So the moral of the story is that when it comes to predicting the future, do your own homework. Now, most of the time when you try to predict the future, you'll be wrong. But when you do your own homework, you'll know why you're wrong, and you'll be able to put measures in place that will improve this aspect of your trading. And remember, you should never be in a position whereby you have run out of trade ideas. Bad and average traders worry about the past. The great traders focus on the future. And they have lots of ideas in this regard. Rule number 9: follow big money. As a high stakes trader, you must accept that your most profitable opportunities will materialize when big money make significant decisions about their long-term futures. Now, When I say big money, I'm talking about commercial hedgers, large speculators who use a lot of leverage, for example, hedge funds, and central banks with their dual mandates regarding economic growth and price stability. Now, you may not agree with the perspective of big money. For instance, since the start of the COVID-19 pandemic, I have not been, I have not been in agreement with regards to how the Bank of England has dealt with the situation. But guess what? Markets, mu- big money move the market. So we don't, unfortunately. The only thing we can do is try to gauge the sentiment of big money and to act accordingly. And when I say act, sometimes the best course of action is just to sit on our hands and do nothing and wait for either A, our own views about the future to change, or B, for big money to change their views. Now, this brings us on to our next rule, which is rule number 10: maintain a watch list. A watch list is a list of securities that you want to trade, but you're just waiting for confirmation from big money participants or from the markets. Now, you must update your watch list all the time because you just don't know when the markets will present to you those rare and exciting money making opportunities. Um, And unfortunately, when these type of opportunities exist, they don't last very long. Consequently, you will only have time to act. You won't have time to think or do research or do any type of due diligence. So maintain an up-to-date watch list and keep yourself ready and prepared. Rule number 11: don't fight the markets. Now, let's say for a particular market, you are bullish, big money participants are bullish, and the market is in a is in a strong uptrend. Therefore, under such a set of delightful circumstances, you should look to build a bullish position, and probably during some kind of retracement. Um, Now, it will not always be the case that you, big money, and the markets will be in agreement. When these disagreements occur, you might still have a viable trading opportunity. Um, because let's face it, no one is right all the time. However, with this sort of trade, you will probably need to make a few adjustments to your trade management plans. But for the most part, your career as a high stakes trader will be a lot easier when you trade in the same direction as the markets. Rule number 12: understand the prevailing narrative. Now, at any given time, big money participants have a limited set of concerns regarding any given asset or security. Your job as a trader is to figure out what these concerns are and to then develop your own opinions about these concerns based preferably on first-hand evidence. This is because sometimes big money participants are quite far removed from the realities of what will ultimately determine the price of an asset or security. Rule number 13: always trade with a catalyst in mind. Now, for high stakes traders, the only thing worse than a position that is losing money is a position that is not doing anything at all. We traders, we like it. We like big market moves, and these sort of significant price movements occur when there is a catalyst, and a catalyst is usually an event or a series of events whereby the market has to deal with new information. So whenever you instigate uh, a trade, always keep a catalyst in mind. This will hopefully allow your position to have a little bit of extra volatility. Now, this type of catalyst, the type of catalyst where you know it will occur in the future, you know the date and the time, this is a planned catalyst. But you can also have an unplanned catalyst. For example, a surprise political event or an unexpected change to the overall economy. Um, and an unplanned catalyst has the potential to not only affect the markets within an economy, but also affect other markets in different countries across the globe. Now, it is impossible to know when an unplanned catalyst will occur, simply due to the fact that it is unplanned. But so the only thing you can do is to make sure that you are always in a position to act quickly in order to secure significant profits. Rule number 14, become obsessed with money management. Now, financial trading isn't just about making money. It's about keeping the money that you make, because as the old saying goes, a fool and his money are soon parted. So if you want to become a high stakes trader, you first need to master money management. And money management is a broad umbrella term that encompasses risk management, stop loss placement, which has effects on your position sizing, trade management, financing for overnight positions, payment for trading services such as data feeds, your living expenses, and taxes. So, if you want to make a lot of money, you first must learn how to deal with a small amount of money. Rule number 15. Always look to increase your AUM. AUM stands for assets under management, and it's just a fancy way of referring to the size of one's trading account. Irrespective of your trading style, obviously it goes without saying that having a lot of money in your trading account is better than having a small amount of money in your trading account. So how can we increase our AUM? Well, the most obvious way is you have a job that provides you with a regular income, for example, in the form of a salary, then you could use this to top up your trading account. But you should only do this when your trading account is making new equity highs. Alternatively, you could go down the road of OPM, or other people's money. This option is only really viable once you have a track record of at least 12 months. However, on the internet, you do get these online funding programs whereby you have access to more funding, provided you pass some sort of trading performance test. Your OPM options could also include becoming a professional trader for a financial institution, such as a bank or a hedge fund. Now, if the institution offers a base salary, then expect a lot of competition. Furthermore, searching for these opportunities will consume a lot of time and energy. So there is an opportunity cost factor that you will need to deal with. Also, when it comes to getting a job as a professional trader, unfortunately, you will need to jump through a lot of hoops as deemed appropriate by professional recruiters and HR people who quite honestly don't know anything about financial trading or speculation. Now, if an institution offers some sort of profit share agreement, then you will need to have between 12 and 18 months of savings to support you and to pay your bills. You could also go down. You could also explore the possibility of setting up a managed account. A managed account is when people deposit money into some sort of broker account, and you trade the money for them in exchange of sometimes a fixed fee, or most commonly some kind of variable fee. For example, a commission on trades that you instigate. To be honest, I've never run a managed account, but based on my limited research on the topic, um, I'm under the impression that the type of platforms and brokers that offer managed accounts, um, they, they only allow you to trade from a limited pool of markets. Furthermore, if you don't have any trading credentials or qualifications, then unfortunately, most investors won't want to work with you. This unfortunate fact of managed accounts, for most high stakes traders, be a frustrating source of additional opportunity cost. Rule number 16: trade the markets, not your portfolio. Now, during the previous 20 years, I have spent a lot of time learning about trading and the markets. Uh, Consequently, I've come across various books, videos, blog posts, and podcast episodes that support the view that during a drawdown, you should reduce your risk exposure. And what by risk exposure, I mean percentage of your capital at risk. Now, now, I applaud the creators of these sources of information for wanting to help traders deal with drawdown periods. However, however, I question the logic of their suggestions. For you see, in my video titled "Habits of Successful Traders," I I discuss that I state that trading is a form of self-expression. So when you're going through a drawdown period and you allow this drawdown period to dictate your risk exposure, what are you really saying? Well, this course of action is the equivalent of saying that your past trading performance dictates the quality of your next trade idea. Now, obviously, this doesn't make any sense because your trade idea is affected by a wide range of economic and business considerations. And none of these considerations pertain to your individual performance as a trader. So, whilst it might be appropriate to use the size of one's drawdown to determine how you will build a position for your next trade idea, you shouldn't allow the drawdown to dictate important variables such as your percentage risk exposure or your stop loss placement. Rule number 17: know your edge. Your edge as a trader isn't your trading strategy. It's not your money management, it's not your trade management, and it's not even your trade idea. Your edge is you. You are the edge that will determine your financial future. So, yes, treat the markets with respect, but don't forget to treat yourself with respect. Make sure you get lots of sleep, lots of exercise, drink lots of water, eat your fruit and vegetables, and make sure you spend time with the people who are dearest to you. Now, this all sounds like basic stuff, but why should we make things more complicated than they really are, or more complicated than they need to be? If you want to become a high stakes trader, then look after yourself, be patient, and make sure you make logical trading decisions that are a good fit for your psychology. Conclusion: I hope this video will put you on the right path to become the type of high stakes trader that you've always wanted to be. Throughout our discussion, I have referred to 3 of my previous videos titled 1. habits of successful traders. 2, trading mindset hacks for new traders. And 3, if you've got poor trading psychology, then watch this. I will leave a link to those videos down below. I will also leave a link to a relevant video that I made titled How to Become an Intelligent Trader and Investor. Thank you for your time and happy trading.